This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. He's Chris Fergus and I'm Gabriel Stvore. Welcome back. Chris, what do you got for us today?
Gabe, so as we always start out these podcasts, excited to be here. Here's a quote from Ray Dalio, one of the top investors of all time. So I saw him with this interview. He was talking to a variety of investors, and he's basically outlined the steps to succeed in any sort of goal. And it sounds super simple, but in executing it, I can think of multiple times in my own life that I wanted to do something and I didn't quite achieve it. And it's because this simple path broke down. So here's his quote. It's more of a stepwise thing, but so his steps are, in his 5 steps: define what your goal is and just anticipate that there will be problems achieving that goal. Step 3, after anticipating the problems, you diagnose what the problems are. Step 4, design solutions to the problem. And then he really emphasized, then you have to do it. You cannot just theorize about what the solutions are. You actually have to do something about it. And I can think of numerous points along this path that at least I have failed on multiple occasions. So I remember for a while I was really busy with school and I was getting out of shape. So I didn't even have the goal to be in shape. So I didn't even have any fitness goals. So clearly it did not go well. Then I can think of other situations where things were going on and I didn't even realize there was a problem. So if you have a goal, sometimes things can be coming up. You don't even really understand that there's a problem there. So you have to diagnose the problem. For example, I was working in a medical clinic and people would be calling in and the numbers wouldn't work. So I didn't even realize there was a problem unless I checked into it. And then diagnosing the problem. Is it the computer system? Is it a particular person that's just dropping the ball? Where is the problem? Coming up with a solution is a whole skill set into itself. And what was interesting is when he really emphasized you have to do something about it. You cannot just philosophize. And I can think of a lot of people who have financial goals on retirement. They'll read lots of books. So they'll realize where they are right now. They'll want to retire with a certain amount in their bank account. And so they know there's a problem. They've diagnosed the problem. They will design all of these steps, but then at the end of the day, they don't actually do anything about it. They just sit. Where a lot of people read about real estate investing, but a lot of people don't actually pull the trigger and make the investment. So it seems like a very simple but elegant way to really achieve whatever you want.
Well said. Well said. And I agree. It's all about action. You can read as many health self books as you want in life, but unless you actually do something, those books aren't going to help, right? You actually have to do something. All that reading, all that planning has to end with action.
Yes.
So, yeah.
I also really like that he just started off. You have a goal, just anticipate there are going to be problems. It is not going to be easy.
I agree. If it would be easy, everyone else would be doing it, right?
I agree. There's that saying, if more information was the solution, the world will be filled with billionaires with six-pack abs. There's lots of information out there, but it's the doing that matters.
True.
I can't remember where I got that quote, so I'm not taking credit for it.
That's excellent. That's excellent. I got to remember that one. Awesome.
All right. So we are talking about cap rate today.
Excellent. Yeah, just a short episode on cap rates. So a cap rate is a good way, an easy way to compare different types of real estate investments, right? So if you're looking at 3, 4, 5 different houses to invest in or real estate properties to invest in, and you're not sure how to compare them, which one's better, which one's not better, which one, because they all cost a little bit different, or the rent is a little bit different, or the property taxes might be different, et cetera. It might be a little bit daunting to compare them. How do I compare it? What do I focus on? And a cap rate is, you do some number crunching, you get a number, and that number helps you compare relative properties to other properties. And it's not to be confused with a return. It's more of a comparison. It helps you evaluate one property from another one.
So I think the best way to illustrate this is, do you have any hard, like actual examples?
Yeah. So basically, let's look at a few examples. But before we do that, just a quick theory, right? Is, let's say you buy a house for cash. So you have no mortgage on it. So let's say, keep the number simple. It's $100,000 property. You pay $100,000 cash for it. So you paid $100,000. Now the property is yours. You rent it out. So now you got rental income. You have no mortgage on it. So the only expenses you have are things like property taxes and property management and some regular upkeep and maintenance. And that's it, right? And so after you've paid all those expenses, how much money do you have left at the end of the year, right? Because you've collected your rental income, you've paid these basic expenses, and let's say you have $5,000 left over at the end of the year. Well, you had to give up $100,000 cash so that you can get $5,000 every year of income. So that's a 5% return, right? $5,000 on 100,000 investment. And if you pay for a house in cash, then the cap rate works. Your cap rate actually is equal to your cash on cash return, right? You paid $100,000 out, you get the $5,000 back. When you pay for a property with cash, it's the same thing. It's your actual cash on cash return. Most people don't buy a property with cash. Many people mortgage it, et cetera. So that's when the cap rate is not used as a return. It's just as a comparison. So you can look at different properties and compare them. So a typical example here is, I love this website called Roofstock. Again, full disclosure, Roofstock is not sponsoring us. We're not getting any money from Roofstock. I just like to use their examples because it's a great website if you're new to real estate investing. They have really good, easy to follow numbers on their website. And I bought a house on Roofstock about 2.5 years ago. I had a positive experience with them. Not to guarantee that you or anyone else would, but I had a good experience with them. And I like the way they present their data. So I'm going to share my screen. And there it is. Okay, you should see my screen now, right?
See it.
Perfect. So here are some properties that came up on Roofstock. I just did a search a few minutes ago. And these are in various places across the United States. This one here is in Illinois. This one is in Virginia, Kansas City, Missouri, another house in Missouri. I mean, they're all over the place. And you can see, typically, the most relevant numbers people look at are things like the purchase price, which is here in this case, this is the $65,000, annual return, cap rate, et cetera. And you can see in this case, the cap rate, let's say, is 7%, or in this case, it's 8%. And so if you ever want to see how do you arrive at this 8% cap rate, you would actually click on this and they'll give you some more details. I'll look at that in a second. But if you look at cap rate, that's the really quick way to compare these two properties, right? Which one should I invest in? Should I invest in the $130,000 one? Should I invest in the $175,000 one? One's in Missouri, one's in Virginia. Which one's a better investment? Whatever. And if you're looking at a lot of properties, then one way you can quickly eliminate which ones you're interested in or not interested in is the cap rate. So right off the bat, if I were to look at these, I would gravitate toward the higher cap rate than the lower one. And that's a big difference between, say, 8% and 4%. So that is a good way that's a good explanation of the cap rate, is that when you're comparing a lot of different properties, the higher the cap rate, the better, right?
Let me just jump in. So things that may influence the cap rate is, so again, to summarize, the cap rate, correct me if I'm wrong, is the net income over the total value of the house.
Exactly. Or in this case, the total purchase price that you paid.
So
yes.
It does not take into account if this is leveraged or not.
Correct.
So it's just how much money are you getting relative to how much the property is worth, which is why it's a good way to compare houses to multifamily, et cetera. Of course, if you leverage the money, then you're looking at other financial measures that we won't get into today. Things that may impact your cap rate. So if you're in a really desirable neighborhood, then there's going to be more competition for those houses. So the cap rate is going to go down, but you're living in a nicer neighborhood and there's more security for the house. If you get a not so great neighborhood, the cap rate is going to be pushed up because well, someone may shoot through the window, or the house may burn down, or who knows, depending on how bad. That's an extreme example, but depending on how bad the neighborhood is. So if you're going to compare cap rates, you really should look at similar locations. But also the appreciation may vary depending on location. So the cap rate does not take into account that appreciation factor.
100% agreed. And thanks for pointing that out. You're absolutely correct. Appreciation does not factor into the cap rate. So a cap rate, generally speaking, higher cap rates, investors might gravitate toward it if an investor is looking to purchase a property primarily for cash flow, not necessarily for appreciation. You just want to invest your money in a place where you're getting a lot of cash flow, but the property might be old. It might require a lot of maintenance. It might be in a bad neighborhood. You might not get a lot of appreciation. It might not be a very pleasant house to look at, etc. You're buying it for cash flow. That's where the cap rate really makes a lot of sense for you to look at, right? That's where you would pay a lot of attention to the cap rate. If you're buying it primarily for appreciation, or you really like it, you may not be all that interested in the cap rate. One example here is, it's a beautiful home here, $275,000 in Georgia. It's a beautiful house, over 2,000 square feet. It might be a wonderful investment. You might really enjoy owning this house. But look, the cap rate's only 2.8%, right? Because it's not a cash flow generating property per se. You might be buying this. It's a very good neighborhood. You might be buying this because you expect there to be a lot of appreciation. You might expect that you're going to get high quality tenants who aren't going to destroy the property. I mean, there's a lot of good reasons to buy it, but if you're buying for cash flow, this may not be that property. And that's what the cap rate shows.
And then you're stronger with math than I am. So how would you generate the cash that you're actually generating? Because if you have the cap rate percentage and the total value of the property, well, how would you sort out the cash that you're getting?
You mean the annual income, right?
The actual annual income.
Yeah. So what this says is, we can look at the example here. We can look at the assumptions that Roofstock here made with these properties. I'll click on one of these in a second. But basically, if someone were to spend $275,000 cash to buy this property, and they were to rent it out based on the rents in the area for houses of this size, you take 275,000 multiplied by 2.8% times 2.8 divided by 100. At the end of the year, you would have leftover cash of $7,700 as an estimate, right? After you've collected all the rent, you've paid all the property taxes, property management, general upkeep. That's how much you would be left over. Now, again, some investors will look at it and say, you know what, that's very low. Like, I can do a lot better than 7,700 by investing in properties that have a higher cash flow. Like, maybe you can buy 2 or 3 of these $65,000 homes and generate a lot more cash. But this one, you're going to have better appreciation. Maybe you're going to get better tenants. You're going to have that many problems. You have a much better chance of your tenant paying every month, and as opposed to your tenants being unemployed or delinquent or getting behind in payments, et cetera. So it's a different type of investment.
The thing that I think this also doesn't take into account is the type of tenant you have. So there's some tenants. So I've had great tenants in not as expensive properties and horrible tenants in really nice properties. However, if you have a more expensive property, you're more apt to have, just because of the nature of the rent is higher. And if you're doing a credit check, background check, tenants with really good credit scores are unlikely to trash the property. Tenants, if they can only afford a minimum amount of rent and they have horrible credit, they, in my experience, tend to be more likely to not take care of the property because they can't even take care of their own credit. Now, of course, there are exceptions to that, but those are general trends. Also, again, these don't take into account vacancy rate. So if you're in like the $65,000 house and the rating, it's in a not great neighborhood, that's assuming a certain vacancy rate that may or may not be accurate, because maybe something happens in the neighborhood because it's not a good neighborhood, and then suddenly 6 months out of the year it's not rented, and that destroys your cap rate. So there's exactly. Like in those houses with a high cap rate, there is a higher, I feel like, risk with those houses.
Absolutely. 100%. Yeah.
Quick story. So I knew someone who he bought about 12 houses in Detroit. All the houses were about $10,000. And he functioned as his own property manager. Do you know where this is going?
It sounds like it's going to have a bad ending, but keep going.
So he was doing really well. So he was really responsible, and he'd buy the houses, put a little bit of work into them, rent them out, and he'd just collect all the rent and see he was saving money. So then one day he went to knock on one of these houses, and then the tenant, I don't know if they were confused, thought it was someone else, shot him through the door with a shotgun. So now he's dead. And unfortunately, then he left behind his wife and son with no dad. So he was trying to do everything right, but because it was a really bad neighborhood in Detroit, that was the outcome. So there are issues with really low income housing.
Chris, so again, as a side note, we are trying to encourage people to invest in real estate in this on this podcast. So I really hope that was like a really outlier of a story. That's definitely not a common theme.
So I think that so I agree with you. Investing in real estate can be very, very profitable. However, there are risks with it. So if you're investing in a F-class neighborhood for a house for $10,000, it may look great on paper, but there are risks with it. And I think my issue with a lot of the investing platforms out there is they paint this rosy picture of everything will be perfect and go do it. And then people slam into the wall and they say, this is not the reality. However, on the flip side, I can tell you that there was a guy who went to school for engineering, and he bought a house because he was from another country, bought a house and rented out 3 rooms. And then he didn't have any money, no money at all, no financial support. He was just in the country on a student visa. So he had nothing, literally nothing. And he got through school and he got a job as a computer engineer, and he hated it. But so he had this house and he sold it, and he made more just because he just rented it for 4 years. So he bought it in a good area and made more selling that house than he had in a full year of working full-time as a computer engineer. So he told his wife, I am done. I'm no longer being a computer engineer. And his wife said, you're insane. But because it was a nicer small town that was growing quickly. So then he said he went door to door and just started calling people. And he said, I'm going to be your property manager. And he built it up. And now he manages about 15,000 units, has a few hotels, and I can tell you has a really nice car.
How many units?
15,000.
That he's managing?
Yes.
That's
a whole team. It's not just
well, I imagine he must have several employees or a team of employees to manage. That's incredible. Good for him.
So he has done exceptionally well, but he was also careful in selecting the houses he'd manage. And of course, he's been very safe. He's been financially very successful and has never really had issues over that many properties. But he's careful, but that's in a nice small town, relatively safe. It's not downtown Detroit in a really, really dodgy part of town. So
yes, so his story illustrates that it is possible if you're careful
possible
to manage 15,000 units without being shot. I mean, that's fantastic.
Yes,
thank you for both stories there, for the perspective, Chris. Thank you. And you're right. Just an example. I mean, while we have Roofstock up here, for example, I can do a quick search here, and I say, show me the cap rates on this website that are like really high, right? Like say 10% plus, and see what kind of properties come up. And surprise, surprise, it is some very interesting properties that come up, like a $37,000 home in Michigan, right?
I'm familiar with Saginaw, Michigan, and that is a rough neighborhood.
Yeah. So there you go. So you pay $37,000, 15% cap rate. Like you said, it looks really rosy on paper, but me personally, I would not feel comfortable buying that property, right? And who knows what kind of a tenant. I don't want to get into the specifics here, but you're right. Like the number might look very high, but there's a lot of other things to consider. So
I think, so the point of these two very contrasting stories is you can't just look at the cap rate in isolation. You have to take this whole thing into perspective. And if you have safety mechanisms in place, like you're physically going to safe neighborhoods, of course, bad things can happen, but you're in safe neighborhoods that are appreciating, the cap rates may not be as strong, but your long-term appreciation, which the cap rate does not take into account, can far outshadow anything you get on any sort of cash return.
I agree. Absolutely. And so you have to find your own sweet spot and what you're comfortable with and how much you value long-term appreciation versus high cash flow. And you have to find your happy place in between those two extremes. And I think with real estate, you can pick a house that cash flows like crazy, but doesn't have a lot of appreciation, or I don't need the cash flow, I'm all about appreciation, or you can go midway and find that, like, you can find properties all over that spectrum.
And that's the beauty of real estate. It can really be as risky or not risky as you want to. Some people may have it in them where they're totally fine walking around with a bulletproof vest and going into the dodgy neighborhoods and saying, this is what I'm dealing with. And they can get great cash flow. The appreciation may not be there, but if they pick an area in transition where it's really sketchy and dodgy, and then it's transitioning into a more cleaner, upscale neighborhood, you can do phenomenally well. But there is that risk profile in doing that. And again, that's why I like real estate. But I also think you have to be very aware of what you're getting into if you're doing this.
Well said. Well said. Yeah, so a lot on my mind right now. Today is Sunday, January 23rd. As we're recording this, I'm really curious how the market is going to open up tomorrow. Last week, it was 4 straight days of market drops. And actually, some of the smaller cap stocks have been just on a meltdown since the fourth quarter of last year. So I'm really curious how the market's going to do tomorrow. But that's a different topic for a different episode, I guess.
As a quick comment, so did you see that I think the reason I think that happened is one of the companies that make the virus boosters, they just tanked because it showed that the boosters are not effective against the Omicron virus. However, the Omicron variant is not which is unfortunate, but the Omicron variant, which is what's plaguing everyone right now, it's supposed to be not as deadly as the other one. So but it's a lot more contagious. So everyone will get it. Odds are you'll be okay. And then hopefully we'll just move on by the time December gets here.
I think so. I mean, like the case numbers are so insanely high over the last 2 or 3 weeks. I mean, if everyone's getting this, then everyone's going to build up some kind of natural immunity to this thing. And I can't see us having another wave or another spike that's worse than what we're living through now. So like, I think this is the worst of it. And hopefully, like you said, in a few months, maybe by summer, it'll be gone.
And if you look back at history, if you look at the Spanish flu and how many people died from that, that was horrific. And of course, COVID has been horrible, but it is not as bad as history has shown. So I think we'll be okay.
I like the optimism.
There you go.
I'm there with you, man.
The big question is, are you gonna like throw some money into the market, or are you gonna hold out?
No. So yeah, it's a good question. So no. So actually, right now, I sold a little bit of my stock just to have a little bit of cash. Most of my stock is still there unsold, but I sold a little bit just to have a little bit extra cash. I do think that, and again, I don't know. No one knows, but
no one knows.
I do think that there's going to be a bit of a pullback, a bit of a correction sometime in the next 3 months or 6 months. That seems to be most of the rumbling or news or whatever. That seems to be the general consensus. And if that happens, at least I'll have a little bit of cash to buy back some stocks at a lower price and lower my cost basis. And then I think eventually we'll return to the same norm that we are at now, which is where the government spends like crazy and most of that money ends up in the stock market and the stocks will continue to go up. But I think there's a bit of a correction coming in the next little bit. I'm probably wrong, but I'm not doubling down at this particular point in time.
All right. As always, Gabe, thank you so much.
Chris, it's always a pleasure. Talk to you soon. Thanks.
Talk to you later, Gabe.